Yo, 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 what up, guys? Multi-dimensional trading here. We're going to go ahead and do some live trading with Papa Powell gets on and he speaks today. So we're going to go ahead and live trade during, or at least look for a setup and see what um, Powell got going on for everybody here today. So yeah, that's what we're going to do. We're going to look for who got um, the good setups, what charts got the good setups. Is it Tesla? Is it Nvidia? Is it NQ? Because right now we're on NASDAQ 100. I mean, we've had some really good price action this morning so far. We've had our liquidity grab down here. Guys, take a look at that. That's what I would consider the liquidity grab here. Smashed right below these lows and then kind of took off. So it's looking pretty substantial to keep going north right here. The only thing I can think that would obviously cause it to go the other way would be Papa Powell coming out saying something and markets start to react and then it goes down pretty fast or pretty quick. In this case, it's been consolidating, it's been ranging, but pretty good movement. If you really do the math, we got 420 up to 500. I mean, these are almost 100-point runners right here, at least 50, 60, 70-point runners. So those are really nice bumps off of this 420 line, right? Really nice rolls off the 420 level. So, and of course, we always use the number signals because we always find very strong zones on the number signals. I wanted to use 369. I just felt that if this thing did start to run downwards, Powell gets a hold of have his way or whatever he says, I just felt like it would blow through this area. So we went with the lowest low here, just in case things went sideways. We go with the lowest low. That way we would find some type of support here at equal lows, right? It'll be equal lows on multiple time frames. Obviously, this is the 1 hour. It will be equal, obviously, on the 2 hour. It'll be an equal point of contact on the 4 hour, and so on and so forth. You guys get the point. We're just looking for equal points of contact on multiple time frames to confirm we have a strong support area. Right? That's how we find our support. Is we're looking for multiple time frames lining up, matching up, looking for matches on multiple time frames. We go down to go up, to the daily. That's also a daily low as well. So it's a daily low all the way down to the 1 minute chart. That's a equal low right there. So we go all the way to the 1 minute chart. That's also an equal point. So at every time frame from the 1 minute all the way to the daily, they will all be at the same point in time, space, and the same price. So that's the point of equal lows. That's how we look at equal lows. So for right now, what we have, it looks like we could go up though. We have our 369 EMA. Let's start to use the 369 EMA because it's actually really dang accurate. I mean, if you take it down to the 1 minute, you're going to see like, when it was time to go short, every time it found the resistance when it ran into that 369 EMA, right? So very accurate, and obviously looks like it finds support when it comes down. Just like same way we use the number signals, right? if the price is running down towards these number signals, we're looking to go long, right? Price is running up towards a number signal, we're looking for shorts. We're looking for reversals, right? So I love it. It's obviously super accurate. If you took your trades and shorts off of it earlier, you would have been very nice in the money in that one. Very nice in the money on that one. Um, Very nice. Or just use them as your take profit. Like, okay, I got in at the lows, run it into my take profit. It makes a lot of sense. And that's the 369-day moving average that we are using. And obviously, as you can see, it's acting as support right now. So it's looking like it's going to be resistance turn to support here. That's what we're looking at. So, yeah, I think Powell talks. I think he talks in about. It's either 11:30 or it's going to be at 11. I think it's 11:30 though. Either way, I think this gives us plenty of time. If it's 11:30 to look at our trades or do a little bit of charting together live here, so everyone can see what we're doing, how we're doing it, how we're looking at the market. And it's a very simplistic way to look at the market. We're not really looking for anything substantial. It's just the lows, the highs, right? We long at the lows, we short at the highs. There really isn't anything else to trading, honestly. It's just buying low and selling high. That's the only way you can make profit, is buying low and selling high. Or selling high and then buying it back low. That's the only way to make profit in this game, right? So that's all we're aiming to do here. Let's see. Yeah, that 369 EMA is acting as a great support right now. And it was resistance earlier. Now we're looking like we are going to be bouncing off of that level. So that's really cool to see it work like that. Because using the EMAs, that's pretty new for me because I really never really needed to use the EMA. But I put the 369 on just to see how accurate it could get, if it gets accurate at all. And lo and behold, it has been pretty consistent lately. So I'm going to just go ahead and throw it on there and obviously practice with it, learn to trust it, and that's pretty much all we do. Just like the number signals. I mean, I've got to see the number signals work over and over again. Bounce off of 420, 444, 666, 777, 888, 963, 316, 333, 227, 444. Right? I got to see these number signals work over and over again. So we trust it when it happens. We trust it when we see it. We know we can take the trade on those signals. And we know we have a really high probability of the chart reversing very strongly there. Right? Like we take a look at Amazon. Know that we went through Amazon a few times. But of course, the number signals didn't fail here. Multiple times, right? Price came down. This is the 1 hour chart. This is in the open market. This was really big moves on those Amazon option contracts as well. When did it hit? Our number signal 666. So the price was 166.60. So just a variation of it. That was a key number signal for us to be ready to take our long trades here. Price goes up, comes back down on earnings and spikes right into that zone, touching that number signal again and taking it right off. Like it literally went from this level straight up $20. Yeah, that happened in the aftermarket, so we didn't participate, but still, if you were playing equity, if you had margin account open, that would have been a huge move to participate in. And the only thing you would have had to do was place your limit order at the number signal. and got filled at the best possible spot you could have got filled at, and then ran it all the way up. Same with the open market, best possible spot to get filled at, and run it back up. Okay, so it's it's how we use it. We trust it. We understand that those levels, those numbers create very strong levels almost every single time. So learning the 369 or the new the EMA that I'm using, I just have to learn to use it and get experience with it so I can trust it just like we can with the number signals. But so far, so good on that EMA. So 369-day moving average has been pretty accurate on multiple time frames. So you guys give that a try, give it a look, and check that out. So Amazon's moseying on. Let's see. We take a look at Tesla here. Tesla probably will go up. Yeah, Tesla probably spike because the Fed rate decision is going to come out, I think, in the next minute here. And then Jerome Powell comes on and speaks, right? So maybe Tesla spikes, maybe Tesla goes down. We'll see what happens right now. We're not really trying to predict the market. We really are just going to react. That's the best way to play news, right? Just react. You can pick out levels all day. That's cool, but if you react to it, it's like at least you didn't get burned. You didn't put yourself in harm's way. You didn't put yourself on high risk for no reason. So, well, that 1 hour closed red on Tesla. Let's see if it breaks up. Also, a new 4 hour on MNQ just opened. And it's going crazy right now. A little bit of volatility here. Looks like everything might break to the upside. And once again, it deviated pretty far from that 369-day moving average on the 1 hour. So chances are it could reach for this area. And it would make a lot of sense because this would be break evens where everyone who basically consolidated here, what happened to them? They got flushed out. So if we reach back up to here, that would make sense where a nice pocket of liquidity is, right? There would be probably a lot of people with a lot of sell orders right here. Like, we don't really have to look at level 2 or the order book. We could see pretty much what happened with the traders or the institutions or the people who were in on this chart. Well, they were here. Obviously, they were buying. They were pushing the price up, hoping that we continued for higher prices, but obviously that didn't happen. They got flushed out for hours here. So if and when the price does get back to them, we could deduce that it's most likely going to be time to sell because these cohort of people, institutions, individuals, mom and pop shops, family offices, all of these individuals who were here hoping that the price would go up, and this was a long period of time for this area. Also seen some really bullish candles. Probably got a lot of people waiting and hoping. So a lot of people took the lows again, trying to go for support. It pumped. It ended up dumping on them for hours after that. So it trapped a lot of people up there. So if it does get back to them, if they're not wiped out, they're not all wiped out, right? Leverage, they're not all wiped out because futures is pretty high leverage. The cohort of people that are still in this area will most likely sell when it gets up there. And guess what? It also matches up with our 369-day moving average. So another confluence to know to kind of take our trade short there. If and when it does get up there, right? So that's how we're looking at the chart. That's how we're reading the market. We're using common sense concepts. We're just basic human behavior, basic psychology. Just what are people thinking? How are they feeling about it? We've been there. We've lost money before. We know how it feels to be in the massive drawdown. Sometimes you can stomach it and weather it out and see, okay, this shit's got to come back to me at some point. And if it does come back, clearly you're going to get the hell out of the trade, because why would you hold it? You already was down a lot. Now you're finally back at break even. You're back at zero. You don't have to worry. You can live to fight another day, trade another day, use that capital on another trade. So that's pretty much the basic idea of what break evens is. It's like, hey, these people here, they consolidated here, they got into the trade, they bought again, but it didn't work out. They got trapped. It flushed down on them. People bought here, flushed down on them. So if and when it does come back to them, we can deduce that we're going to have a strong area of sellers right here in this area. So how can we use that to our advantage? Well, of course, we would be here, right, trying to sell our contracts along with them. It's as simple as that. That's all we're looking at. That's all we're looking for, is something that makes sense, common sense. I mean, there's really nothing else to trading but buying low and selling high, or selling high and buying low. And the only thing we're doing is figuring out where to buy low and where to sell high. That is it. That is it. There is nothing else to it. There's different methods that you can use and indicators and stuff to give you plenty of confluence and help you find where to buy low and where to sell high. But at the end of the day, it's not complicated, guys. A lot of individuals do make it a little bit more complicated than it has to be, but it really isn't complicated. I mean, yeah, you could read candles and price action and this and that, and it's good to understand it. When you see wicks is bullish, you see nice flushy candles is bearish. Sure, I mean that goes without saying. You can see people are dumping the stock, right? But some people think it's a little bit more than what it is, and it's not. It's just, look, a group of people bought here, a group of people got screwed. If you were this group, you just ask yourself a common sense question. What the hell would you do when the price gets back to you? Well, if I was in here and price ran down, by the time it comes back to me, I'm already got my orders here to sell as well. I'm hoping and praying it gets back so I can get out at zero and I can take that capital to use on another trade, and I didn't take a loss, because not losing is also a win in this game. Going home with your shirt is a win in this game. Okay, and that's facts. Okay. But yeah, this is where we would take the trade. You see how it lines up perfectly with our 369 EMA. Right here perfectly into break evens. As you can see, you see these wicks that got broken. So when it comes back, break evens, these people would be at zero. They would be saved, and they probably would think, well, let's get the fuck out of here. We're out. We'll look for another setup. Simple as that. All right, so let's take it down to the 3 minute here. 3 minute ran into the 369 EMA, and it's going short right from that EMA. That is amazing. All right, let's take a look at our options. Okay. Our options at 5 cents right now on the 15-minute chart. We would love for it to come down to 1 penny and get it at a major discount. So we'll see if that happens on our Tesla put, right? So we just want to make a couple of cents off of it, 10 cents contract. That's all. Something small, something very profitable, because the very low risk, right? Because we're not trying to risk a lot of capital. Just play the options as it is, very low risk. So we'll see if we can get a push to a penny over here on these calls. I'm sorry, these puts for Tesla. Okay, Tesla looks like it's going to be coming down. Once again, you see that 369 EMA has been acting like a strong resistance here. Look at that strong resistance. 369 EMA is giving me a really key signal. It's time to go short, right? So can't really be mad at that. Can't be mad at that at all. Let's look at Bitcoin real quick to see what Bitcoin's doing. Damn it, it's already back to 58K. It's about to run into that 369-day moving average as well. It was just at 56. But once again, if you look at the number signals, if we type it out, you'll see where the chart always finds a very sharp support. Clearly 56,666. That was a clean support. So if you had your orders there on Bitcoin the first time, nice run up. That was about a $2,000 runner almost. In right here, nice run up. In right here, nice run up. So as you can see, you always find support on those very specific numbers, or resistance at very specific numbers, right? Remember, if it's going down towards the number signal, we're looking for longs. If it's running up towards the number signal, we're looking for shorts, right? We're looking for those reversals. It's that simple. All of our concepts at multidimensional trading are very simple, very easy to understand. I mean, you could teach a child to do it. They will understand this. It's not that hard. Watch our multidimensional trading video series. There's 10 videos, and we go through all of our simple concepts. It's really 5 main things, honestly. It's the number signals, equal highs, equal lows, the break evens, the bubble theory. That's pretty much it right there. And of course, we have the liquidity grab, which is something that we learned from ICT, right? That is a very effective thing when you see lows that are broken and you know the stop loss is resting below them. Time to get the hell in and run it the other way. You know, when a lot of people are waiting for things to get broken so they can take their short, we're buying there. I really don't understand why they wait for it to get broken up here and then take a long, or get broken down here to take a short. To each his own. Maybe it works for some. I'm not sure. That is not how I wish to take risk on my money, though. I'm going to buy at the lowest point and sell at the highest point. Not buy when it gets high, when it breaks out. That's crazy. But if it works for some people, it works. I've just watched it not work a whole bunch of times when a lot of people call out, hey, we're going to take a trade after it breaks this high. I'm like, okay, but it has to fall back down anyway, so what's the point? I don't know. To each his own, guys. Um, I like to follow simple, common sense concepts. Buy low, sell high. It's as simple as that. That is all we're doing. I don't want to buy up here after we took the run. I want to buy when no one else wants to buy because we know where it's most likely have a high probability to rest on support and stop. Can we have those strong confluences that you practice with and you've seen it work over and over and over and over again? You don't really hesitate to get into the trade. You know it's money. You know it's money. So there's no need to be like, oh, well, look at all these people buying. Well, let's see it break this CMA and then come back and retest it and then we'll get in. Dude, write it up. EMA could be your TP1. The break above that could be TP2. Anybody getting in on the pullback, great, good for them. But you've already done your business way ahead of the crowd. The crowd's looking for a break above these highs, and you're done. Finito. Turn the computer off. Go home. Using simple common sense concepts. Okay, let the other guys worry about the breaks and the retraces and all the other shit that comes after you get in from the bottom. Because even if you got in on the bottom and you watch the shit run, they're trading that. You're not. You're sitting here at the bottom, chilling, probably got a stop loss on and break even or slightly into profit. And everything else that's going on ain't got shit to do with you. Unless it's hitting your take profit or something. So, I don't know, guys. I say let's keep it simple as possible. Buy low, sell high. You know, Warren Buffett will say it over and over. Just you buy good companies at discount prices. You sell them at premiums. I mean, not, oh, wait till it gets high and then sell. Wait till I have 2 days of green and then buy. Like, no. No. Like, what the hell? Like, no. We're not waiting 2 days so the candles can go all the way up and then get in. I've seen too many traders do that, and I'm like, why the fuck are you waiting for it to get all the way up here to take the trade? That doesn't make any logical sense. It's like it doesn't make any mathematical sense. It doesn't make any logical sense. And it just like, it's like they don't have any confluences that give them the ability or the confidence to take the trade down here. It's like this doesn't confirm it for them, right? They not practice with this method or these numbers or these levels over and over. So I guess they wait for a different type of confirmation, which is buying pressure, seeing basically us, our group of people who are thinking this way, buy first. They need to see us buy and push the price up. Then they'll say, okay, well, there's enough smart people buying it. It must be the banks. I'm going to get in. When really it's just people with common fucking sense, man. Sure, the banks get in at the bottom too. But the rest of us are just using common sense to find these support levels. Because that's all it is. Everything is just support and resistance. The way and the methods that we use to find support and resistance may be different. But the only thing we're all looking for, as anyone who is trading on these markets, gambling on these markets, whatever you want to call yourself, whatever you believe you're doing, you're still just looking for where is it going to have support, where is it going to bounce, where is it going to fall from, where is resistance going to kick in. That's all the hell we're looking for. That's it. All right, so we're back on MNQ here. It's 11:17 now. I believe Powell will go on at 11:30. So let's see if we can get YouTube to show us. Federal Reserve. Here we go, right here. There goes Papa Powell. May 1st at 11:30. They got a little countdown on there and everything. That's nice. Okay, I see you, CNBC. Yeah, CNBC is legit, though. Because, I mean, you get to listen to a lot of professionals, a lot of money managers, hedge fund managers, CEOs of different companies. And it's hard to sit there and listen to someone who's got a lot of experience in the field of finance and not learn anything. It's like you're going to learn something by sitting down and listening to people who actually went to school. They do this. They've been doing this for years. They've had tremendous success. They're running large companies. They're running large funds. You're going to learn something when you sit down and listen to those people. Okay? Yeah, a lot of people come on there and they just want to say something to manipulate a stock one way or another. Sure, you can look at it like that, but you also can see it when you hear different terms, different lingos. If you don't understand something, you just go and look it up, Google it, figure it out, so you can start to understand the conversation on CNBC. Because there's a lot of people who would sit there and listen to them have a conversation and hear, oh, the stock is expensive, earnings per share, they'll say EPS, and you got to understand what the hell the terms are talking about, or else you're just listening to people speak basically a foreign language that you're not aware of. And if you go and look up the definitions of words that you don't understand, then you'll start to understand the conversation that's been had on CNBC. There's a lot of different lingo that you'll hear the CEOs and fund managers say, and it's like, well, wait, what the hell are they talking about? Well, this stuff isn't taught in school, and a lot of them are professionals, and they've been doing this for years. So if you like to understand what they're saying and what they're talking about, look it up. You hear a phrase or a term or a group of letters put together that you don't understand, go and look it up, because what they're giving you clear signals and clear messages as to how they want shit to go and how things are going. But if you can't understand the language that they're speaking, then you're basically just listening a foreign language that you don't understand. But yeah, CNBC is really good to sit down and listen to a lot of interviews, a lot of CEOs, a lot of hedge fund managers, money managers, and you can't help but to learn from them when they talk, right? Because it's not like we grew up with the information readily in our faces, right? So we didn't go to school, we didn't go to college. A lot of people, if you're here on YouTube right now, you didn't go to school and college for finance. You don't really have to go to school and college for finance. But if you learn, you pay attention, you listen to people who are obviously actually doing it or have done it before, you're going to find success. And if you practice on your own, you're definitely going to find success, right? Because can't nobody do it for you. Right? Somebody can guide you on which way to go, but if you don't take the trades, it doesn't really matter. I can look at people till they're blue in the face and say, hey, these are the number signals. See 420? Look how it bounced on 420. You could have just took the trade off of 420. I could talk to people till they're blue in the face and say, hey, you see these number signals? That's 666. Look how it bounces off of 666. You could just take that trade over and over if you wanted to. And I could say that, but if they don't apply it, what fucking difference does it make? So it's not like I can teach you anything. Okay? You gotta take the information and apply it and teach yourself that it works. That's the only way that you're gonna understand that what you're looking at is actually valid. Because if you don't trust it, if you don't learn to trust it, which is I can't teach you how to trust it. I can't teach you to trust it. Only thing I can do is show you how it's working for me, and then all you can do is take it and apply it and see if it works for you. And if it does, then through that process, you will learn to understand it and trust it for yourself, for your own strategy, for your own capital. Because nothing that I'm saying here is financial advice. This is get it how you live, on to each his own. I'm giving guidance on how I do it. And if you guys like that, hit that like button, subscribe. If you guys like this content, hit that like button, subscribe. We're doing our first, I guess, live stream for the Powell speech. We haven't really ever done that. We've watched it before live, but we've never done a live stream with Papa Powell giving a full-blown speech. So we're going to see how that goes and see how that feels. And if I like it, then I'll continue to do other ones. If I don't really find it, beneficial, then maybe not. But yeah, we'll see how this goes, though. I'm not really going to trade Bitcoin. I'm most likely going to be on MNQ here. So we'll see. I'm going to get my chart in full screen mode here so we can see everything. And we got about 6 minutes till Powell goes on. So let's see that. Webull, we're at 5 cents right now. So we'll see. Yeah, we're looking for a spike into that penny zone. So got our stock options with the limit order. We got our futures contracts over here with the limit order. So we'll see what hits. And if those don't hit, then we'll react to what happens in the market. We look at our 1 hour chart. And the reason we're looking at these larger time frames because the chart tends to move when Powell talks. So we kind of want to see what will most likely happen on a larger time frame. Even this 316, I'm like, if this looks bullish right here, I'm not going to lie. This looks bullish. I like how it doubled bottom and retraced. Also did the liquidity grab, and it's been going up for the last 2.5 hours, right? Notice you see 3 candles, but it's 30 minutes or left, so about 2.5 hours it's been going straight up. So I love how this looks. So that looks very bullish. Now, if shit goes sideways and Powell ruins the moment, then maybe this will hold up. This 316 will hold up. Remember, it's a daily low all the way down to the 1 minute, so that's how we're looking at our equal lows. If we do get a bullish spike, maybe we'll short here at this area, this break-even zone, right, where people got flushed out and got screwed. So we'll see how that goes. Looks like we got some movement on the chart. And once again, this looks very bullish and it's on the 1 hour, so who knows how long this could rip. But we got 2 right up in there. Looking at 17,888 because that 888 has been hitting a lot lately. So I wish we just took the long here and stayed in it, honestly, because we kind of got in the bottom earlier and then we took some profit. But yeah, we definitely probably could have just swung it. Yep. I think Powell goes on. Says about 1 minute and 1 minute and 40 something seconds right now. So we'll just see how the chart reacts to Papa Powell. Let's go ahead and give this some full screen action over here. Here I'll allow us to see trades or pick different ones over here. And then, yeah, we'll do that. Let's see if we're going to get smashed on. Will it go lower than 5 cents? 3? No? Alright, so here we go. It's about to be 11:30 right now. There goes Powell right now. Alright, here he comes. 1, 2. I don't know if you guys can hear the background of the video, but this is my first time doing a live stream, so I'm using OBS. I'm not really familiar with how everything works, but we got the microphone, got some headphones on, we got our screen showing, so I think we're doing okay so far, so good. Let's go back to look at MNQ here. MNQ. Yeah. Dang, I'm hungry as hell. Oh, wow, I waited so long to do everything. I should have ate again. Should have ate again. Dang, flatline at 5. I just need you to spike down. Oh, snap. About to give us some bullshit.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal.
I don't know if you guys can hear him.
Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace.
Change the rates. Continue to reduce
stance of
the
monetary
security
policy has been putting
holdings
downward pressure on economic
as
activity
expected.
and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1%.
Oh, I got talking about that. I'm like,
as strong as the second half of 2003.
he's gonna talk, and I don't think much is gonna happen when we zoom
Consumer
out.
spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past
Make
year,
it
but
pump,
remains
make
above
it
our
pump,
longer
or make it
run
dump, make it do something.
Total PCE prices rose 2.7% over the 12 months ending in March.
Damn, look at
Excluding
that.
volatile food and energy categories, core PCE
369
prices rose 2.8%.
EMA. Accuracy.
The inflation data received so far this year have been higher than expected.
That's accuracy
Although some
right
measures
there.
of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored.
That is
as reflected
accuracy,
in a broad
right?
range of surveys
Yeah.
of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning
Guess we
inflation
should
to
take
our
this
2%
short.
objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that
Like
we do not
usual,
expect
nobody
it to be
knows
appropriate
which way to
reduce
fucking
the
go.
target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared
He
to
just said he
respond
gonna
to
do it forever.
weakening
That's what I heard.
We know that reducing policy restraint too soon or too much
He said he gonna
could
do
result
it,
in a
hold the
reversal of
rate
progress we've
forever.
seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its
Grab
ultimate
that pull
level
back
more
off that
gradually.
EMA
In
though.
particular, slowing the pace of runoff will help
Look at
ensure
that
a smooth
accuracy.
transition, reducing the
Crazy.
cost
I
of
gotta learn to
money
trust it,
markets
but
and
man, if you
stress,
look down on that 1
thereby
minute,
facilitating
it's
the
literally
ongoing
found
decline
your
of securities holders.
resistance, and now they broke through it and found your support. That is pretty
We remain
freaking
committed to bringing
cool.
inflation back down to our 2% goal and to
That
keeping
is
longer-term
pretty
inflation
cool.
expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country.
I think he says
Everything
the
we do
same
is in
thing
service to our
every
public mission.
every
The Fed will do everything we can to achieve our maximum employment
Every
and price
meeting.
stability goals. Thank you. I look forward to your questions.
here goes the questions, y'all.
Thank you. Howard Schneider with Reuters.
This is it.
Question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic. But
I hope you guys can hear
hear
Powell speak. It's pretty cool if you can.
That's demand.
Like I said, it's my first time using
The same is true of quits
OBS
and hiring
to
rates,
stream
which are essentially
an
normalized.
actual live session.
I also look at
For this
we look
long,
at
I guess.
surveys of workers and surveys of workers and businesses, and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored?
Are anchored.
Are anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current.
All right, pal.
restrictive
He's
stance of
been
policy
pumping
as
it.
long as it's appropriate.
Dang. Who took that EMA though? At 1 minute. Ooh, that was
Thanks for taking our
clean.
questions, Chair Powell. I wonder, obviously,
That was real
Michelle
quick.
Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit
Let's take a
considering
look
raising
at
rates
the
at this point?
1 month.
So
Don't wanna
I think it's
freak myself
unlikely
out here.
that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
There we go.
Well, I think, again, the
Only
test,
question is, should we be
what I'm
at
saying is,
8,
if
8,
we were to
8?
come to that conclusion, that
The only reason I
policy might
asked
tighten
that
up to
question is
achieve
because it's
that.
like,
So it would be the totality.
still
of
at break
all the things we'd
evens,
be looking at. It could be expectations, it could
but
be a
it
combination
saves a
of things, but
lot
if we
of
reach that
people.
conclusion and we don't see
Because
evidence
when you
supporting
look,
that
there was a
conclusion,
lot
that's what it would
of
take, I think,
people
for us
here
to
at this area
take that
for a
step.
long period of time. That's how I'm looking at it.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So,
There's nothing
has the
wrong
Fed
with
sort of dropped
going
its
with
easing
the
bias? Where are you
highs.
standing on that?
Let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think,
Took
that
that long
policy
off
is
of
well positioned to
420
address,
though.
address different paths that the economy might take.
The
And
liquidity
we've said that we
grab
don't think it would be
definitely
appropriate to
went
dial
north.
back our restrictive policy stance until we gain greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we
Definitely
did have a
went
path
north.
where inflation proves more persistent
See
than
what my
expected,
boy
and where the labor
said.
market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take, which would cause us to want to consider rate cuts, and those would be two of those paths.
Yeah, we'll see what
We
happens
do gain
here.
greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening.
I'll just go with the number
for example.
signals just in case.
Those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you
What
now
if you guys
expect a
can hear
period
it?
of sustained
That's all I keep thinking about.
tighter
Like,
financial
everybody hear what
conditions
I'm hearing
will be needed to resume the sort of disinflation
with
that
the
economy saw
OBS.
last
So
year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation, and that's really what we're trying to do is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
So was that a trick question,
Not really.
young lady?
So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should
Powell
take some
some
signals.
water.
We don't like to react to 1 or 2
Selfish
months data, but this is a full
motherfuckers.
quarter. And I think it's appropriate to take signals.
Man, that
And we are
break
taking
even
signals.
zone
And the
was
signal that
good,
we're taking
though.
is that it's
See
likely to
those
take longer
2
for
wicks
us to
right there?
gain confidence.
Oh,
that we
I
are
wanna hit
on a
that
sustainable
area.
path down to 2% inflation.
I just feel like he's
That's
gonna
the
go
signal
past
we're
that just a little bit. But it probably ain't going straight up,
Mr. Chair,
though.
if I could, Steve Leisman, CNBC. If I could follow up on that, what particular areas were sort of
area
temporary
looks
blips in the inflation data in the first quarter?
good.
What's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah.
Makes me
So
want to put my
we will,
order right back.
we will we have put the thing under a microscope. I will say nothing is going to
Put
come
our
out of
orders
that
right
that's going
back.
to change the view. I think that, in fact, we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
If I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And is
is it going to hit our level?
A plan we've long had in place to.
Got a new hour and
really not in order to
6 minutes here, guys.
Provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Come on, let's go. Come on, let's go. All right.
From Bloomberg.
Come on, let's go. Come on, let's go.
One, given the run of data since
Run up.
has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs.
Bitcoin.
Given your history there, I wonder if there's an argument for being
5
with inflation here. We have strong productivity
Still
growth.
pretty far off.
That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it. But is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably on at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very
taking
hard
that
for
long.
forecasters
I've been
broadly
lovely
to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years,
about it.
Our sort of
I know
framework
420 was
document
clearly
says that,
nice, and then we
you
had
look
the
at the two
liquidity
mandates,
grab, and then
one of
north
them's further
we
away
go.
from goal
Bounce off the
than the other.
369
Then
EMA,
it's the time to get
continuation.
there, times
Very beautiful.
times how far it is from the goal, and that was clearly inflation. So our focus
Very
was very
beautiful.
much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the U.S. economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that
Okay, got some stock moves
last
in
year's
there.
level of
What's
growth
up?
was very high, 3.4% in I guess the fourth quarter. And probably not
See
gonna
what's
be
up with the
sustained.
stock
It would
moves
come
we
down,
got
but that
right
would
now.
that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation actually.
Powell dropping jokes. Okay, Powell, I see you.
Michael McKee from Bloomberg Radio and Television.
You
The
said I
vice
don't
chair
see the
of
stag or the
FOMC
inflation.
said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
I think I would take that question this way. We saw a year of very high productivity growth in 2023, and we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy. That's not about productivity. It was about having more labor, frankly, both through in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists, getting our arms around what that means for potential output this year and next year. And last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, you've got more supply, but those people also come in. They work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately, it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, and we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's really that's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly restrictive monetary policy.
No, fuck.
Based on what we're seeing. How long
No, it hit that area, hit those break evens on the nose, man. It's over.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
So we're.
I think it's over. Or is it too early?
What we think the right thing for the economy is, when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right.
Over. Is it too early?
If we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing. And we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And so we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
Right and break
And then is there a significant difference
evens.
between, whether you start in, say, September versus December?
Of course,
There's a
guys.
significant difference
Of course.
between an institution
Right and
that
break
takes into
evens.
account all sorts of political events and one that doesn't. That's where the significant difference is. And
Right and break evens.
We just don't do that.
It just
you can
nicked
go back and read
it.
the transcripts
It
for every. This
barely fucking nicked it.
Fourth
Look
election.
at that.
Fourth presidential election.
Right at break even.
And see if anybody mentions.
I just was thinking like maybe it could go a little
just
bit
isn't part
higher
of
because
our
Powell
thinking.
was
It's not what
talking,
we're
but
hired
nope.
If we start down
Liquidity
that
could
road,
only
again,
go as
I don't
far
know.
as liquidity allows. If the only orders are here for sellers, like we talked about earlier, that's the
Thank you, Chair
only
Powell.
place.
Question about the labor market. You've mentioned a few times that
People
the
are
labor
gonna
market is
sell.
normalizing. Certainly today's JOLTS data suggested
Yeah.
that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening.
Oh,
Is it a
well.
lagging indicator? Or
That was
something else
nice
going on?
too.
So I think if you go back to where wages peaked, wage
was very
increases
nice.
peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And, again, we don't target wage increases, but in the longer run, if you have wage increases running higher
It's over. Look at
than
that 1
productivity
hour.
will
It's
warrant,
done.
then
369
there will be inflationary
right there
pressures.
on the
Employers will
EMA.
raise prices over time if that's
Break
the case.
evens
So
hit.
we've seen progress. It has been inconsistent.
It doesn't
but we
get
have
any
seen
better
a
than that,
substantial decline overall. But it
Everybody
is-
up. Fucking 300, 400 points damn near. I can't be mad at that.
You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards.
Perfect
People
zone.
looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at anyway. Headline peaked at 7.1. Now it's at 2.7.
Yeah, that was good. Cause look, I was from
Quick follow-up.
780 all the way down 713. Huge
Yes, I mean,
points.
I think that restrictive monetary policy is doing what it's supposed to do, but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand.
Check the 3 minute.
So I think now you see those two things working.
3 minute, 15. Like we could press up a little bit more
from the pandemic and response
we'll see
to
though.
it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess 2 questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low, but it takes. Before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between
well, those still was good moves, man. At least you took the one off that EMA. That would have been a really good move.
Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation, and so they're navigating this pretty well this time.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market.
Come on, man. Sirens in my live stream. That's wild.
Labor market. In terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate,
I had a damn good short too.
And then, do you need to resolve
probably it right here,
issues
guys.
with the capital proposal
We'll
in order
see.
to advance other parts of the regulatory agenda, or do you
I
expect
just wanna
to
grab
make
that.
progress on those other agenda
That.
items?
You know, there's no mechanical rule in place there, but I would
Eight,
say
eight,
that
eight,
the,
you
the
know.
Basel III process.
It might
is by
not
far
even
the
go
most
that
important
high.
thing and really
Probably
is, I
dump
think,
here.
occupying us at this time.
So it looks like
in
it's
terms of
running out of
what's
steam.
What we're moving ahead with.
Thank you, Mark Hamrick with
like
Bankrate.
we're running out
Mr.
of
Chairman,
steam right here.
what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into
Probably the
what
end
we're
of the day
doing.
right there, guys.
And I think many people, if they feel that's
That's
happening,
probably
that
fucking
for most
it.
people, most of the time, that'll
Trying
be
to come
nothing.
down for the rest of the day
I'm
now.
not. It's not frowned upon or
We'll
or
see.
against the rules. or
Yeah,
anything like
that's
that.
it.
It just is the way
That's
things come
fucking
out.
it.
And,
Y'all
I think
knew
we
it
have a
was
very
it.
diverse group around the people. Frankly, more diverse than it used to be.
We gotta hold those trades, man.
From the obvious,
No, scalping is like,
demographic ways, but
well,
also
no,
we
that's
have,
it, though.
more people who are not.
That's
PhD
fucking
economists.
it, guys.
So we have people from business and
That's
law
it.
and academia and things like that.
Let's see.
So I think you actually do have quite a good diverse perspective. I think all of us read these
nice,
stories about
nice,
the lack of
nice,
diversity, and we look
flushy
around and
flush
say,
right
I really
there.
don't understand what they're talking about. So, but I get the question now. Thank you very much.
Is he done? Oh shit, pal's done. It's over, cuz. Yeah, it's gonna dump now. And talked it all up. We had like the perfect short. I wanted to go higher. I guess we should have just right there. We'll see. We'll see. I mean, I doubt it just runs all the way up, but it's 12:21. It's going to put our orders there one more time. I always cancel once you take a scalp off of some other trade for some reason. I guess it's a feature, not a bug, but whatever. We'll see how this goes. Look at that 15 minute. That shit ain't coming back. It done already broke the previous 15 minute. It's over. Powell's done talking. The shit done ran up the whole damn time. People about to take profit and go the fuck home. Shit, stock market about to close. It's over. Yeah, we should just be in that shit. Riding that bitch down to the ground. Look at that, right at break evens. Almost touched the 369-day moving average. Right at break evens. Fat fucking hourly about to come down. Fuck, we should be in that right now. I was hoping like, all right, we get a spike, more spike back up. Nah, you should just stay in that shit. For real, for real. That was money right there. How many lots you use, how many contracts, that's money right there. Shit, hell, this was money. It's going up. It's fire. That's how they get everybody to go long. But y'all see how it looks like a good long position when you see those candles? But then you go to your 1 hour, you look at this at a multi-dimensional way where you're looking at multiple measurements, which is basically, that's what a dimension is. It's a measurement of something. You look at the 1 hour. Oh, hell no. That motherfucker fat and ugly. To the red. Looking at the 15. Okay, like, damn, nah, that shit just broke these ones. It got 6 minutes left. Okay, you're looking at stuff like that. Like, why would I go long right away? Could it go up? Yeah, it could. But is it high probability? No. So the only things we're trying to take is the ones that are high probability. Leaving my fucking order here directly at break evens without all the shenanigans and the area bar or whatever, and trying to put the zone just right there, break evens like I normally do, just drawing one simple line. That's it. That is it. Because look how effective that is. I mean, right here, break evens was 787, all the way down to 6. That's 100 points right there. You know what I mean? It's 100 points. It's craziness. That's crazy. 100 points? It's crazy. That's good money. You know what I'm saying? At a predetermined level. I mean, we didn't get down here, didn't catch it off the EMA. I mean, your next good trade that you could see clearly was clearly at break evens. But you know me trying to catch the top or the bottom, whatever. Yeah. Do 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 do. All right, let's see what we're looking at on our trade. Wonder if we could modify this order and change it into good to cancel. I wonder. Oh, time and force. Good till cancel. And it ain't coming back, y'all. I'm just gonna go with 15 over here. Alright, with Jerome Powell, that's it for Jerome Powell. One viewer watching the live stream. Thanks for the one viewer. I think that one viewer is just me, but hey, it's all good. Well, we're gonna wrap it up here, guys. We had fun. Should have took better trades though, honestly. And we'll see you guys in our next live stream. So we'll see y'all later.